At Heartland, part of our assessment of stocks is looking at financial soundness, including balance sheet strength. We focus on gross and net debt to EBITDA, much like a credit analyst. Our goal is to ensure that A, companies will be able to service their debts without issue, and B, repairing debt is not the focus of the company. We prefer management teams to spend their time operating the business. For example, M&A is something we analyze very carefully. Many small-cap stocks that get on this M&A treadmill do a deal or two. They put debt on their balance sheet and it becomes permanent because they don't have the free cash flow generation, the business strategy, or the discipline to pay down that debt in relatively short order. We like to invest in companies that have a manageable amount of leverage, and oftentimes we focus on companies that do have debt. But there must be a catalyst which is evidenced by an inflection in free cash flow generation, which could lead to subsequent deleveraging. Or a company that may have a non-core asset they desire to sell, which could bring down debt in a reasonably short period of time. We think small caps contain two big risks: financial risk and operational risk. Operational risk is hard to avoid in small caps. Generally, they lack scale, have smaller management teams, and less bandwidth in the management teams, so operational risk tends to be inherent in smaller companies. On the other hand, financial risk is associated with levered companies. Lots of debt can cause operating risks to be very high, a combination of risks we do not like to take. We continue to use our 10 principles of value investing, which guide our assessment process and help us determine if the stocks we are picking are financially sound.